No interruptions, then maybe I can do it in 40, maybe I can do it in 35. I'll try and push that you've got as much time as possible.
But we've allocated that 1 hour basically, and then we'll start the formal AGM at 10.
No interruptions, then maybe I can do it in 40, maybe I can do it in 35.
All right.
I'll try and push that you've got as much time.
Sandile, I'm sending you via chat.
We've allocated that 1 hour basically, and then we'll start the formal AGM at 10. That background thing now.
Maybe I can do it in 40, maybe I can do it in 35.
All right. That's my YouTube channel. I'm going to stop it. So.
Okay. Very confusing.
All right.
We're not made for these things.
2, 1. We're bringing everybody in.
Okay. All right. I'm off. I'm switching off my camera and going mute.
Can you see it now?
Yes, thanks. Good morning, ladies and gentlemen. We are just about to start now. Welcome to this, our Savrala AGM for 2021. Thank you very much. If we could move just as always, in these meetings, we always cite our competitive notice, which, I won't go through the whole thing, but basically just to say that, accordingly, care must be exercised to ensure that any of the association's meetings are not used as a means for collusion between its members. Certainly, this one is not meant for that. The agenda was circulated. The first hour is dedicated to our speaker. I'd like to just welcome everyone, welcome all the members of Savrala, and also just welcome our guest speaker, who is Nikki. I have indicated in the invite that I sent you that today we're honored to have Nikki. Nikki Varma is the Nedbank's chief economist. She has been the senior economist since 2000. She received her master's in economics from the University of Stellenbosch in 1994, and soon advised government on economic procedures and policies in her capacity as an economist in the Central Economic Advisory Service, which has since been integrated into the President's office. Her experience in the banking, securities, and brokering industries has given her a broader knowledge of a wide range of fields within economics, including sector analysis, fixed investment trends, as well as the relationship between real economic trends and developments within the financial markets. At Nedbank, Nikki focuses on trends in the overall economy, looking at the cycles in the economic growth, inflation, and interest rates. She regularly does talks all over the country to all, events and all types of audiences, including business forums, property groups, large corporate firms, and government entities. It is my pleasure to welcome Nikki. And at this stage, I'd like to just hand over to Nikki. Nikki, over to you. Thank you very much.
Hello, everybody. Great to be with you today. If we can go to the first slide, my aim today really is to talk you guys through recent developments, specifically in the vehicle market, and look at what has been happening to the demand for vehicles in general. So we're going to have a closer look at the performance of demand for vehicles. We're going to do this in 3 phases. We're going to start out looking at what's happening to vehicle sales. How has that been shaping up? And then we're going to turn our attention to the future. And we're going to ask ourselves whether the macroeconomic environment will actually be supportive of demand for vehicles in the years ahead. And finally, we're going to have a look at some of the downside risks that could emerge. Not all of the downside risks, because we'll be here for the next 10 years and all grow old. So we're going to highlight the most relevant ones in the current environment. So let's get going. Let's have a quick look at how vehicle sales have been shaping up. And specifically what we want to ask here is, we all know the South African economy was exposed to a tremendous amount of damage during level 5 lockdown. And what we really want to get a sense of is whether or not vehicle sales have returned to pre-pandemic levels, to pre-lockdown levels, whether it's recouped the bulk of those losses or not. Whether we're talking about a simple rebound off a low base, or whether there are signs of some kind of sustainable upswing starting. So let's have a look at that. Now, in value terms, if we just look at the nominal value of both new vehicle sales and used vehicle sales, new vehicle sales really including commercial vehicles and passenger vehicles. Similarly, with used vehicle sales, you can see that in value terms, you have certainly returned to the levels that prevailed prior to lockdown. So you've recouped the bulk of the losses incurred during that very dramatic shutdown in the overall economy in April last year. If we go to the next slide, we'll see that the picture isn't quite as convincing when we look at volumes, right? So we look at the volume of sales, you can see that there is still some subdued elements in this overall cycle. There isn't that much sign of upward traction. It's certainly been a rebound, and it looks more like you just returned to the levels that were, but there's still an underlying downward trend, which is a little bit worrying. Now, you could say, listen, Nikki, even after level 5 lockdown, we encountered a tremendous amount of shocks, and that is true. We have seen, of course, the damage done by what was a very long third wave, and the fact that we went briefly to a level 4 lockdown, and we had a level 3 lockdown. Both of them entailed bans on alcohol sales. Both of them, level 4 briefly had a period where sit-in dining was also not allowed. And yes, it certainly put the economy back in a very significant way, and we saw that in July. And then also, of course, the devastating impact of that very unpredictable and sudden burst in violence and social unrest we saw in July. It was just a few days, but it wreaked a huge amount of damage. And then, of course, we also had the cyber attack at Transnet, which have caused backlogs in cargo, and they're still clearing that up. I understand progress has been made. It's looking a lot better, but it has been a factor that also affected trade in a significant way. So yes, there have been many, many shocks that the economy has had to absorb. since we entered level 5 lockdown in April last year. But overall, if you had to look at it, certainly from a value perspective, the vehicle market looks a lot better. But from a volume perspective, it looks a bit more like a rebound. If we look at the long-term trend, and what we do here in the next slide is we essentially strip out all the volatile elements. And we try to get a sense of the underlying cycle. And if you look at that, you can see that the underlying cycle still suggests that we're heading downwards and that it is very subdued out there. So we still got a lot of work to do. The vehicle market still showing signs of, I would call it stagnation. It's not dramatic downward momentum. But for us to get a better outcome, we do really need a supportive economy. And that's what we're going to look at now. So the longer term trend is a little bit worrying. It's suggesting that we haven't really, in underlying fundamental terms, turned the corner. And so what we're going to do now is we're going to turn our attention to the future. And that's in the next slide. And we're going to see whether the underlying macroeconomic environment will in fact be supportive of demand for vehicle sales in the years ahead, or for vehicles in general in the years ahead. So let's get going with that. The good news is that the South African economy have started its climb out of that very deep pit it fell into when level 5 lockdown was imposed last year. The recovery really started the moment we went from level 5 to level 4. Okay, so in May last year already, we saw the economy rebound as they eased lockdown restrictions. And over time, government got a lot better in targeting lockdowns in such a way that it doesn't completely slaughter the economy and you still get the best sort of health outcomes that you can under the circumstances. Of course, it has meant that lockdown measures have been particularly painful for your sort of high contact industries, those industries where there is a high degree of social interaction between people. But generally speaking, targeting lockdown measures are a lot better than just having blanket hard shutdowns, which is exceptionally destructive and which an economy like South Africa simply can't afford. So because of this, because government got better at targeting lockdown measures, because the private sector learned to adapt, learned to continue to operate, even though you've got quite strict health protocols, switch to digital platforms for sales, which in itself creates demand for vehicles, because if you're going to be doing more deliveries, if a greater portion of the economy switch to that system, then of course it also creates demand for vehicles. And so all of that essentially helped bring about a recovery. So the economy has bounced back, and what we saw is after a very steep contraction in the second quarter of last year, the worst decline we've seen since the Second World War, the rate of decline slowly moderated and it turned positive off a very low base in the second quarter of this year. Generally speaking, this recovery has been faster and it's been stronger than any of the analysts expected. So much so that by the end of June, we had a situation where the economy was just 1.1 percentage points short of its pre-pandemic levels. So that's the encouraging bit. Here's the thing though, it is a rebound. It isn't evidence of a convincing economic upswing starting. It is just a rebound off an exceptionally low base. It's also important to remember that this rebound has been exceptionally uneven. It's been uneven among income groups. Lockdown has hurt your lower income earners far more than your higher income earners. In fact, lockdown has been highly supportive of higher income earners. It's been uneven among sectors. Producers have generally bounced back quicker. Services, your professional services have coped with this crisis really well. Manufacturing has also coped fairly well. Mining has coped exceptionally well. And then your high contact industries from travel, tourism, all the way through, they've been exceptionally hard hit by the lockdown measures. So uneven among sectors. And very importantly, if we go to the next slide, you'll see that it's also still a very narrowly based recovery. What do we mean about that? Well, in an economy, there are essentially only a few sources of demand, any given economy. Your growth is either coming from households, it's coming from government, it's coming from companies, that are going out there, taking the risk, expanding their operations, or it is coming from the export market, right? So essentially, all four of them, which is the ideal situation where you have a broad-based recovery. Now, in our case, this recovery has been brought about by government leaning against the wind. So government didn't have a lot of funds available. We've been running budget deficits of over 3% of GDP for an extended period of time, well, over a decade, in fact. And over that period, public debt burdens have been climbing. During this period, we've had several sovereign risk rating downgrades. And so government really was in a bit of a corner, but they did what they could. And they kept spending constant, which is that yellow line there. But the big lift came from the rebound in consumer spending, okay, which is the dark green line there, and particularly from the resurgence in exports. And obviously that's been a function of the global rebound, but also from a very nice run in commodity prices, which gave us this enormous windfall gain. And South Africa went from having a trade deficit to having a massive trade surplus of over 10% of GDP, from having a current account deficit to having a massive current account surplus of over 5% of GDP. So that's been absolutely instrumental in bringing about the recovery. But it's basically been consumer spending and it's been exports. If you look at that red line there, which is fixed investment activity, you'll see that it tried to stage a recovery from a very low base after imploding in the second quarter of last year. In the second half, it tried to recover. As we came into the first half of this year, fixed investment activity relapsed again. So this is still a very narrowly based recovery, which makes us vulnerable. What we're going to do now, if we go to the next slide, is we're going to look forward. And we're going to ask ourselves, okay, of these sources of demand, what's going to do the job for vehicles? What is going to sustain demand for vehicles, both commercial and passenger vehicles? Well, if we look at the situation, you can see that certainly we're going to be what we really want in the vehicle market. The key drivers here is, yes, government. So government is a source of demand for vehicles, both through consumption expenditure and through capital expenditure. And then, of course, very importantly, fixed investment activity. If growth is strong enough, if your recovery is strong enough that companies' expectations of future earnings change, they start to believe that their capacity will be constrained, that their ability to exploit that upswing will be limited unless they go out there today, raise the capital, take the risk, and expand their operations. And the moment they start to expand their operations, that creates considerable demand for vehicles, right? Whether through the rental space or whether through direct purchases. And then, of course, exports as well. The more trade you have, the more buoyant demand for vehicles. And then finally, you've got that segment of the market which is related to the global situation, and that is really whether you see a revival in tourism, a revival in business travel, that will also create demand for vehicles. So we're going to look at these and see what are the chances that we'll see continued growth coming through, and that the nature of economic growth in South Africa, which at the moment is exceptionally narrow based, could perhaps broaden and become more sustainable as a result of that, and support a nice upswing in the demand for vehicles. So let's start and have a look at fixed investment. The key really here, certainly for the demand for commercial vehicles, from light to medium to heavy commercials, is dependent on what happens to fixed investment activity. Now, here's the bad news. We do think the recovery going forward, we can go to the next slide. The recovery going forward is going to be driven to a large extent by the same factors that's kept it going so far. So we believe we're still going to be sitting with a very narrowly based recovery. Fixed investment activity took a mighty hit during level 5 lockdown. And as I've mentioned, it's really struggled to recover. It is still miles below pre-pandemic levels. And the problem here, and the reason we don't think you're going to see a compelling recovery in fixed investment activity, is unfortunately because the nature of the drag on fixed investment activity is structural. You can't just cut interest rates and suddenly you're going to see more fixed investment. We've done that. We've cut interest rates by 300 basis points. It's made no material difference to the constraints on this economy. So the constraints on fixed investment are actually structural of nature. Now, what do we mean by that? We go to the next slide. Basically, what we essentially mean is that the source of the drag is coming from the implosion in capital expenditure by state-owned enterprises. That's the red line there. And also very weak levels of fixed investment activity by general government. And while the private sector has tried to maintain their capital, they've also not been able to grow fixed investment activity at all right? And that's because of this massive drag coming from state-owned enterprises and from fixed investment by general government. So what's happened here? Well, this is all the constraints we're facing. The fact that we've had this implosion in capital expenditure in state-owned enterprises is also placing a limit on the private sector's ability to expand operations. Not only is it placing a limit on the private sector's ability to expand its operations, but it's making it very expensive to undertake capital expenditure because state-owned enterprises in South Africa provides the bulk of economic infrastructure. And because of this implosion, we're sitting with aging economic infrastructure. We're all very painfully aware of the fact that we don't have enough electricity. But not only do we not have enough electricity, the cost of electricity have increased by almost 400% since 2007 in absolute terms. So there's too little of it, and it is hugely expensive. And that exact same poisonous and toxic dynamic is also visible in all other forms of infrastructure, road, rail, port infrastructure. What all of this does is it makes it physically very difficult for private companies to expand their operations, and secondly, very expensive. So it raises hurdle rates. We've also flirted with some really negative economic policies. We've seen a huge spread in corruption during the Zuma years. We're now trying to resolve that. And I do think that intent is genuine. I really think President Ramaphosa wants to deal with state capture, wants to put a permanent end to it, wants to make sure that people are held accountable for what went wrong over that period. But the destruction that it's really just wrecked in terms of confidence have been very significant. The impact on government finances have been enormous. That we have failed municipalities, all of that raises hurdle rates for new investments. And then at the same time, of course, we've had these riots and the scars that will leave on investor perceptions, we won't be able to measure until many years from now. But I think it will linger in the collective memory of both local businesses and global investors for a very long time to come. So unfortunately, those are the things we need to address if we want to see higher levels of fixed investment. Now, government has identified about 50 infrastructure projects, and we do understand from some of your construction companies that demand is slowly starting to pick up. The number of contracts are slowly starting to pick up. So that's very encouraging news. But here's the thing, until we eventually get to that point where we have restored the viability, the financial viability of state-owned enterprises, we've improved governance, we've gotten rid of corruption, and therefore we've improved the efficiency of whatever spending they undertake, whether it's consumption expenditure or capital expenditure, we are going to sit in a situation where fixed investment activity is not going to have a lot of upside. So eventually we think this will recover, but it's going to be very slow to recover. And of course, the most immediate constraint is the next slide, which is, of course, the fact that we just don't have enough electricity. Now, here too, there's been progress. Government's allowed 100 megawatts of embedded generation. So that suddenly looks a little bit more positive. But here's the thing, it's still a cost to companies. They've got to be convinced that essentially demand's going to pick up sufficiently to warrant them going out there, undertaking this expense and putting in their own electricity generating capacity. So the reality is that eventually we do think more and more private firms will do this, but it will take time before it starts to lift the energy constraint. In the meantime, it's a very real constraint. After all, we're now sitting with level 4 lockdown. And it's no accident that the moment we go to level 1 lockdown, we suddenly have to contend with level 4 load shedding. Those two are related. We just don't have the energy capacity to allow faster levels of growth and certainly to enable fixed investment. So this is going to be a drag on vehicle demand in the years ahead. We think that fixed investment activity will start to turn the corner probably next year and slowly gather pace. 2023, 24, 25, but it's going to be a very gradual recovery. And it's going to take a long time, probably 4 to 5 years, before fixed investment just returns to the levels that prevailed in 2019. So that's going to be an element of drag. If we go to the next slide, there is some good news here. And that underlying trading activity, we do believe will remain quite strong. As I said before, exports provided an enormous lift to this economy just when we needed it most after level 5 lockdown. And we now have a trade surplus. We now have a current account surplus. It's supported a recovery in the rand. It's made the import of all things cheaper as a result of that. And it's facilitated to a large extent far greater economic activity. This has been a function of the global rebound. In advanced countries, we've seen the very rapid rollout of vaccines, which has enabled them to lift their lockdowns with a far greater sense of permanency. Plus, we've seen massive fiscal and monetary stimulus. And if I say massive, I mean massive. In the US, it was 12% of GDP. That's how much they injected into their system. They slashed their interest rates. They turned on the printing presses. They flooded the market with liquidity throughout the crisis. And governments really paid companies and individuals directly to compensate them for any closure in their business because of COVID rules or for any loss of employment as a result of that. And that enormous fiscal and monetary support also helped to bring about a very strong recovery and rebound in demand, especially in advanced countries, right? And that has supported demand for commodities, and commodity prices started to rise, and that's what South Africa benefited from. Now, the good news is, listen, the world economy is entering a complex phase, and we'll talk about that when we get to the downside risks. But essentially, it's a complex phase. We're entering this transition period where the world economy is wanting to move from lockdown and disruption to normalization, and it's not going smoothly at all. Okay, you're all aware of what I'm talking about, the millions of shortages that are popping up all over the place. So there is some risk here, but generally speaking, the anticipation is that as more countries start to vaccinate their population, more economies will be able to lift lockdown measures with a greater sense of permanency. Global travel will normalize, business travel will normalize, tourism will normalize, and you'll see these industries start to lift off from a low base, and that will provide added momentum to the global recovery. And so if you go to the next slide, you'll see that the general expectation is that we're going to have another year of fairly strong global growth. Next slide, please. Okay, there we go. So you can see the IMF is looking for, if you look at that top line there, they're looking for another year of above trend world growth, actually very strong, 4.9% in 2022, then still very respectable growth in 2023 of 3.6%, and then they see it moderating 3.2% and so forth, and getting a little bit softer and more subdued. But another 2 solid, strong years of growth, despite all these transition difficulties, right? So if that is the case, and if that materializes, then that will certainly support our exports, and it will also keep commodity prices elevated. If we go to the next slide, you'll see it shows you commodity prices. This is what South Africa has benefited from. Look at that surge in metal prices. And that certainly made a big contribution to our recovery. It's now starting to run out of a little bit of steam, and generally speaking, nothing just continues to rise without some form of correction along the way. And I think we are entering a bit of a correction phase, but the question is, will it turn down? And our view is that commodity prices are probably going to prove to be quite resilient. And the reason we say that is because of many of your advanced countries, you now have a situation where the nature of fiscal support is switching from consumption expenditure, emergency support for households and companies. So that's over, and it's switching to infrastructure spending. And here the aim is really to build infrastructure, let's be honest, to compete with China. That's one major motivation there. And then the other one is to accelerate the transition in order to mitigate climate change. Now, here's the thing about green technology and green transport systems. They use almost 30 to 40% more commodities than fossil fuel alternatives. So the outcome is probably going to be a situation where demand for commodities remain quite elevated. Even though prices might not continue to rise, it will stabilize at fairly high levels, which should be supportive of South Africa. So there is at least some good news. Mining, manufacturing, demand for vehicles coming from those industries will probably remain fairly buoyant. Going to the next slide. So if we had to sum it up, when we look at the commercial vehicle market, you've got underlying weak fixed investment, that's a negative. But there are some signs of hope there. We are seeing evidence of a modest uptick in infrastructure spending coming from government as a result of those 50 strategic projects that they have highlighted. But your biggest constraints to growth in South Africa, which is really the transport system, and it is electricity above all, that's not going to be lifted immediately. So your underlying trend is still going to be subdued and on average, probably still quite negative for the demand for vehicles. The positives is that you're still going to have robust trade, you're going to have better outcomes in the mining industry, and you've got the switch to greater online activity, increased sort of demand for transportation as a result of that. So those are the positives. And overall, we should see increased demand, but it's not going to be a really robust trend that is emerging. We're only going to see that really robust trend once underlying fixed investment activities start to pick up. That's, of course, just one segment of the market. Let's look at the consumer. That's the next slide. Now, as far as consumer spending is concerned, you will see that it certainly has recovered a lot of lost ground. It's not quite back to pre-pandemic levels. And the worrying bit here is, although the recovery has been quite impressive, and again, the consumer has been one of the major drivers of the improvements we have seen, the reality is that it's starting to drift sideways. So that's a little bit worrying. And why is that? Because the yellow line there, which is disposable income, is starting to drift sideways, starting to lose a little bit of momentum, right? So disposable income is really what determines the consumer's ability to spend. So let's have a look at that. What determines disposable income? It is essentially employment growth and it is wage growth, right? Those are the two major factors. And then there's other income. But that's quite a small portion of your overall disposable income or national disposable income. Other income like rentals, interest, profits, that's only about 20% of disposable income. The rest is all compensation of employees, which is a function of employment, and it's a function of wage growth. Here's the problem. Why is it starting to sort of drift sideways? Why does it look like it's sort of, leveling off? Well, because of very poor situation in the labor market. If we go to the next slide, you see South Africa's employment trends. It basically shows you in green there, employment by the public sector. And you can see during the Zuma years, the public sector became really the employer of last resort. It became far too large for the size of the economy. And as the public sector exploded, the private sector shrunk, right? So the public sector literally crowded out the private sector. So you can see they were the employer of last resort. And then from 2014, they started running out of money. And whatever increased spending they wanted to undertake required increased borrowing. You had a series of sovereign risk rating downgrades. The cost of that debt started to escalate. And you can see that employment in the public sector, if you had to draw a long-term trend there, started to level off. In the first half of this year, second half of last year, first half of this year, government upped employment as part of supporting the economy during this difficult period, but also as part of the president's employment program, which is starting to yield some results. But here's the thing, though. There's a limit to what they can do. Government's already too big for the size of this economy. So it's just not sustainable. Jobs created in the public sector at this point is just not sustainable. And because of the financial constraints, because of the budget constraints, because of high levels of public debt, because of a narrow tax base. So at the end of the day, whether you like it or not, you're probably going to see public sector employment starting to level off. And that sort of long-term, sideways drift will probably continue. So it all comes down to the private sector. And if we look at the private sector, which is the red line, you can see employment has been exceptionally hard hit. And it's been weak for a very long time. It essentially stagnated since 2009. There was a brief period of recovery, and from 2012 onwards, you can see that red line is just drifting sideways. Then came COVID. It took a mighty hit, and it hasn't actually recovered. This is the horrible story here. Now, why has it not recovered? We know there's been job creation in some sectors, but in net terms, we haven't really created jobs. We're still hovering near your level 5 lockdown trough, all right? And the reason for that, in our opinion, is because the persistent, over 18 months of pressure on your high contact industries that are highly labor intensive, that's now starting to take its toll, right? And what you're seeing there is that companies are starting to fold in your tourism, travel industries, in entertainment, in restaurants. And as they fold, you're seeing jobs being lost, okay, as a result of that. So the pressure on the high contact industries are really countering whatever job creation might be occurring in industries that have coped better with COVID. All right, so if you go to the next slide, I can show you how sustained that pressure has been. This graph shows you all your major economic indicators within the wholesale, retail, motor trade, as well as hotels and accommodation and restaurants, a broad sector. And what we do here is we take the sales and the income and we index it to 100 in January 2019. And then you can see how have they tracked relative to that point in time. And you can see while vehicle sales, retail sales, and wholesale sales have pretty much recouped all the losses from level 5 lockdown, and are pretty much very close to the levels that prevailed in January 2019. That is not the case in restaurants, pubs, and hotels and other. They are still operating at a fraction of their overall capacity, all right? And they've been doing this for 18 months, and it's getting too much. Companies are starting to fold, and people are starting to lose their jobs. And this is where we think that drag is coming from on disposable income, and it's starting to force it sideways. The good news is, if we go to the next slide, the recovery of wages have certainly been far more compelling. There you can see the red line, that's private sector wages, that has bounced back. So it is starting to recover. It's not back to pre-pandemic levels yet, but it is increasing. Initially, the focus of companies was certainly not on paying their workers more. I mean, it just wasn't the focus. The focus was survival. And in order to do that, they had to focus on cutting costs, and staff cost is a big element of that. Essentially restoring profitability and also strengthening their balance sheets, repaying debt at a very rapid rate. And we've seen that across the corporate sector, across the private sector, aggressive repayment of debt. Many companies are now in that position where they've returned to profitability, where in fact their balance sheets are quite strong, and they are therefore capable of paying better wages and of trying to retain skills as much as they possibly can. So we do think private sector wage growth will normalize. It will return to 2019 levels, and it will provide some support to overall disposable income. But that support is not going to completely counter the drag coming from employment and the loss of employment. And so as a result, we do think income is probably going to be recovering very slowly going forward, initially drifting sideways. And if we can get the entire population vaccinated quickly, maybe by mid-2022, and we see more foreign tourists arriving to South Africa second half of 2022, then this picture can get some legs, and it can start running stronger. But right now, we need job creation, especially in those high contact industries, because they employ a lot of low-skilled labor, which we have a lot of. All right, so we go to the next slide. So employment not going to be a major boost. Wages is going to be a better boost to income. But overall, it's still going to be probably a slow recovery until we get to that point where travel and tourism recovers. But the good news here, especially for vehicle demand, is that households are sitting with better balance sheets, right? We've seen net wealth levels recover quite impressively. That's been as a result of an uptick in house prices, increased demand for residential property particularly, and a very nice run in equity prices. So anybody with exposure to financial assets have done really, really well. And so net wealth levels not only returned to pre-pandemic levels, but actually exceeded it. So there are positive wealth effects. And households have strengthened their own balance sheets, so much so that it's been possible for them to become net savers. If you go to the next slide, you'll see that they are firmly net savers now. So there's the stash of savings. Households have increased their spending a little bit, which has helped to bring about the recovery, but not completely. Okay. They have also been putting a lot more money away just in case things take a turn for the worse. And now that stash of savings that have been built up there, that can be redirected to spending, especially once confidence improves. All right. So there is this potential upside that could come through for vehicle demand. If we go to the next slide, so past the savings to the next slide, the other thing that households have done is they've been very constrained in their borrowing. All right, so they've borrowed more, borrowing has recovered, especially household borrowing, corporate borrowing, not like I say, they've been repaying debt, but households have been increasingly borrowing a little bit more, but not in a way that puts them in any kind of financial danger. So debt levels have been fairly steady, and added to that, interest rates have come down 300 basis points. That is very significant. It's brought debt service cost as a percentage of disposable income all the way down. So people are spending less servicing the existing debt, and that's freed up a whole bunch of funds for discretionary spending. And a lot of that has been directed to buying a new vehicle, all right? And so vehicle sales have benefited from the generally better financial condition of most households. So employment dynamics is really the only blot here. It's the only negative. So if we had to sum this up, what does it look like? Essentially, not too bad at all. We think you're going to see continued demand for vehicle sales. Next slide, please. You're going to see continued demand for vehicle sales coming through from the household sector. It's going to be coming really from continued recovery in household earnings, particularly on the wage front. It's going to come from much stronger balance sheets, which makes it possible for them to borrow. And that's the result of those positive wealth effects, that stash of savings that are out there, and the fact that households are not sitting on a mountain of debt. And that also obviously improves their credit ratings and makes it a lot more possible for them to get financing. The strain is really still going to be the fact that unemployment is only going to reverse very slowly. And it is really entirely related to a recovery in travel, tourism, hospitality, and entertainment. And that is entirely dependent on us getting some traction with vaccinations. On vaccinations, things are starting to look a little bit better. We only have around 25% of the adult population vaccinated at this point, which is not nearly good enough to protect us against COVID and to prevent strict lockdown. But there is some good news here, because if you look at the population cohorts, in other words, based on the age group, the most vulnerable age group is 60 years and older. And of them, vaccination rates are now almost 55% of that population group. And that means if we have future COVID waves, which we certainly will have, I think, there's a very strong likelihood that we won't necessarily see enormous pressure on hospitalization, and we won't see higher mortality rates, because the most vulnerable group is almost at that critical point where you can say that they're starting to build up sufficient levels of immunity in terms of vaccination to prevent serious illness and hospitalization. So there is some good news there. So overall, if we had to sum this up, the positive for the vehicle market and for vehicle demand is that we have strong trading activity supported by the strong global rebound and robust commodity prices going forward. At the same time, we have a consumer that is in a fairly good financial position, that's worked hard to bring its debt levels under control, has had the benefit of nice increases in wealth levels, and are sitting on a stash of savings. And that should see their earnings, if they are employed, improve. And so that should keep this recovery in vehicle demand going for the next 2 to 3 years, all right? If we can resolve unemployment, if we can get our vaccinations at the levels we need to be, if we see a return of foreign tourists, then you'll have even greater upside to that recovery. At this point, it's still going to be contained by weak fixed investment activity and high levels of unemployment. Are there further downside risks? Well, low interest rates have been instrumental in bringing about a recovery for the consumer. So we're going to have a look at interest rates now. We're going to have a look at some of the downside risks we might face. And that's going to be the end of our story. We haven't got a lot of time left to do that in. So we're going to try and do that in 5 minutes. Now, if I had to identify risks before we get to interest rates, we have to point out that COVID is still a risk, okay? Only 25% of the entire population has been vaccinated. And yes, indeed, of that 60 years and older population group, the news is a lot better. Over 50% of them have already been vaccinated. So we are becoming more resilient to COVID. We are becoming more resistant to COVID, but we will probably see future waves. And as a result of that, we're probably going to live with some form of lockdown or the other. If you go to the next slide, that just shows you vaccination rates the world over. Sorry, next slide. That just shows you vaccination rates the world over. You can see South Africa now at 25%. Africa is still very low. But some countries, of course, mostly advanced countries, but not only advanced countries, some emerging markets have also made enormous progress and getting vaccination rates over 60% of their adult population. So increasingly, the world is starting to cope with COVID. And increasingly, I believe that COVID will start to have less and less of a destructive impact on economic activity. But we can't quite dismiss it fully yet. And as a result of that, you have to mention it as a risk. Another risk is, of course, the fact that inflation is mounting. So inflation is starting to increase. If we go to the next slide. Now, in the case of South Africa, global inflation has returned, right? We've seen inflation rise in all countries, including advanced countries. We currently have a situation in South Africa where US inflation is a fraction higher than South Africa's inflation. Didn't think I'd ever say that in my life as an economist. But there you go. US inflation at around 5.4%, our inflation at 5%. So big difference there. So South Africa has seen inflation increase. All of that inflation has essentially come from imported inflation. It's been higher global food prices, higher global oil prices, higher prices on intermediate goods, components, semiconductors, and all of that has really been fueled, of course, by global shortages. If you go to the next slide, you'll see global inflation. Now, I show you what's happened to US, Eurozone, Japan, UK inflation. Producer inflation is even higher. In Germany, you have a situation where producer inflation has risen to over 15%. I mean, it's absolutely phenomenal, 19.1% to be exact. All right, so that's in Germany. In South Africa, producer inflation is hovering around 7.9%. So just put that into a different perspective. So what's protected us? Well, I think partly what's protected us is that companies have sat with a whole bunch of stock after level 5 lockdown, and they've been trying to flog their existing stock. So we have not encountered these supply side shortages, which other countries where demand have rebounded a lot quicker have encountered because we haven't started restocking yet. We're still trying to get rid of our old stock. All right, so that's the one factor. And imports have been contained. The fact that fixed investment has been fairly weak has meant that demand for certain type of products, certainly your sort of big capital equipment and their components have been subdued. And so we haven't encountered global shortages on that front. As demand continues to recover, as South Africa's demand continues to recover, then eventually companies will have to start to restock, and we may then start to encounter these global shortages, and we may actually see inflation start to gather momentum. But at this point, that hasn't been the case. We've seen inflation tick higher, but really not rage out of control as a result of global shortages. These global shortages are going to be with us for a while to come still. I think that's something that the world at large is slowly starting to accept. And it all relates to the fact that you've had this lopsided recovery. One part of the world is vaccinated, opening up, demand is surging. The rest of the world is not fully vaccinated, can't open up entirely. So your production is still being disrupted. Transport networks are still being disrupted. And so you've got this mismatch between the supply and demand, and that is pushing prices higher. And that's going to persist for a while to come still. We're also going to feel the pressure of higher oil prices. That's coming through in petrol and diesel prices. If you go to the next slide, oil prices have risen, in fact, above pre-pandemic levels. We don't think this is going to last. This is not a free market. It is a manipulated market, let's be honest. Saudi Arabia and many of your oil-producing countries have the capacity to increase supply. They've just decided not to do so. In November, the increased quotas will come through, and I think you'll slowly start to see prices starting to drift sideways. Here's the thing, though, as long as you've got this mismatch going on in the world economy between supply and demand, you're probably going to see that oil prices too will remain elevated. So it's not going to continue rising in our point of view, but it can probably remain higher than we would like to see for the next 6 months or so, and then we believe it will start to moderate. So yes, it's a source of inflation, but we believe a temporary one. If we go to the next slide, another big worry, of course, is the rand. The rand really has been one of the reasons we've been so resilient, and it's been one of the reasons we haven't felt the impact of all of surging global food prices, of much sharper, higher global oil prices and higher intermediate costs. It's been one of the factors that's protected us. Just as the prices of all of these goods globally went up, the rand strengthened, and that helped to contain the net impact and the net cost of all imports. So it's really helped us in that sense. But the rand is becoming more vulnerable, and the biggest worry for the rand is that it might come under pressure once the US starts to normalize its monetary policy. Now, if you go to the next slide, you'll see that, as I mentioned, in advanced countries, all of them turned on the printing presses and they injected truckloads of liquidity into the system during the COVID crisis. Now their economies are growing very rapidly, and now they've got inflation. So they're going to have to start unwinding some of that monetary support. And the first stop is going to be tapering their bond purchases. You can see the EU has kind of started. You can see it sort of ticking down there. But the big one is the US Federal Reserve. They're going to start this month. They're going to start tapering their bond purchases. They hope to wrap it up by next year. What are they doing now? Basically, all of that dollars they injected into the system, they're going to be mopping it up. Okay. So that means the dollar would tend to be stronger and all other currencies against it would be weaker. And at some point, they're going to start raising interest rates. And now you have a situation where if you're a risk-free investor, why come to South Africa or Brazil where you encounter a huge amount of risk? Yes, you might get a higher return, but you also take on a huge amount more risk. Well, you can just go put your money in the US, all right, and get the higher interest rate and get the higher return from the higher interest rates. And the general expectation is somewhere towards the end of 2022 and throughout 2023, the US will start to hike interest rates. And so over this period, the rand's probably going to be more vulnerable. And the Reserve Bank is particularly worried about that. If you go to the next slide, we're very near the end, folks. If you go to the next slide, you will see that the Reserve Bank, in fact, believes that in order for them to contain inflation and protect against any weakness or pressure on the currency, essentially they'll have to start hiking interest rates. Now, we agree with that. They do have to start hiking interest rates, but their model is forecasting quite aggressive interest rate hikes, in our opinion. They start this month with 25 basis point hikes, then they see another 1% increase next year and another 1% increase the year thereafter. Okay, so that takes your prime up 225 basis points over the next 2 years. In our view, that's probably not going to happen. All right, we think that it's wiser just to leave rates unchanged. The rand is still holding up. Yes, it is going to be more vulnerable the moment the US starts to taper bond purchases, but it's still holding up quite well. And then we see 100 basis points next year, and then we see it flat for an extended period of time. Why do we see a far more modest increase in interest rates? If you go to the next slide, the reason we see this is simply because South Africa's inflation has been trending down for a very long period. Why? Because demand is subdued, all right? And South African consumers, the South African economy is incredibly price sensitive. Speak to any retailer and they will tell you the only way that they can move volume is if they discount. So it's very difficult for South African companies to pass cost increases onto consumers without hurting their sales volumes. And that, in our opinion, will ultimately contain inflation, will help it to stabilize around the midpoint of the Reserve Bank's target range, and will make it very difficult for the Reserve Bank to justify hiking interest rates beyond 100 to 125 basis points over the next 12 to 18 months. That's our view. Of course, I'm showing you the Reserve Bank's view, and that's where they want to go. They want to go 225 basis points. So interest rates are going to move higher. If the Reserve Bank acts according to their own forecast, then at the end of the day, of course, the impact on vehicle demand will be more significant because interest rates will go up by more. If our version of the future play out, the impact won't be that significant. But regardless of the outcome, the truth is the Reserve Bank, even in their forecast, only foresee interest rates going back to the sort of levels that prevailed prior to lockdown. And those were already fairly low by our own historical standards. So as interest rates normalize, it shouldn't disrupt demand for vehicles. It should not undermine the recovery in the vehicle market. So overall, we are looking at a modest recovery. Let's go to the final section, which I'm really just showing you our forecast. Next slide. And we can just skip over to the very last slide. This is our forecast. So you can see that we're looking at a strong rebound this year. It is a rebound. We're just returning to where we were before level 5 lockdown. And then we see growth moderating, still reasonable growth next year, and then slowing. Within this, demand for vehicles are going to improve, but it's going to improve at a moderate pace. All right. If we want a better outcome, we need to vaccinate. We need to get foreign tourists returning to South Africa. We need travel to recover. We need fixed investment activity to pick up. In order to do that, we must address our electricity, road, rail, and port infrastructure issues and bring the overall cost of that infrastructure down. And I think that is still a way off for South Africa. So thanks. That's my story. Thank you for listening. I think we have gone over a bit with time. We only have about 4 minutes left, but over to you, Sandile.
Thank you very much, Nikki. What a powerful presentation. I think you've given us quite a bit really to ponder upon, quite some food for thought. You've shared, both positive and negative, and these are realities that face us. There's a whole lot of restructuring reforms that have to take place in our economy, but certainly, thank you very much. At this stage, I think it's important for us to just give a few minutes. We were accommodating you. We could listen to you for the whole day, quite honestly. But we were accommodating you, knowing fully well that you have another engagement after 10 o'clock. So that is why we structured such that you are the first one. And then the second formal part of the AGM will start shortly thereafter. But I think, at this stage, it's important for us to also provide, give an opportunity to our members. If they've got any questions, I certainly need to reflect, but I think that's what, we'll do. And if we could just give a moment for any questions to members.
I'll get some water.
Yeah, do it. I don't see anything in the chat.
If there's anybody that have questions, they want to send an email to me, by all means, do it. If you want a copy of the presentation, Sandile, you can distribute that to your members.
Great. I was about to say that with your permission, I'd like to circulate
you can go for it.
Great. I think it's important for us. Oh, yes. No, thank you. Thank you very much. In the absence of any questions, and I'm sure, we've taken a lot to reflect on.
It's a complex time we find ourselves in, folks, and I'm sorry, but it is a nuanced story. There are positives, there are negatives. It's not just all doom and gloom. And we need to give you as realistic a picture as we possibly can. So thanks for listening. And I hope.
Thank you very much. We really appreciate your making time for us, Nikki. Really, thank you very much on behalf of Savrala, the NEC, I'd like to really extend our thanks and appreciation.
It's an absolute pleasure. Look after yourself. Stay healthy.
We'll be in touch. Take care. All right. Thank you. Thank you very much. Ladies and gentlemen, at this stage, I think we'll move on to the second section, this, part 2 of our meeting. All right. We've had quite a bit of, the impact has also already been mentioned by, Nikki, fairly known to ourselves, and the impact of COVID has really been horrendous to the industry. We also have experienced losses within our families as individuals, but also losses within the industry. At some stage, I think early when we started coming back, we hadn't really had any reports of losses. For that reason, there was, one felt quite pleased that at least I couldn't think of anyone within the industry that had passed away. But we've since had, and without mentioning any names, I think in just recognition of that, I would request just before we start the meeting now, the formal section, just a moment of silence. Thank you very much. Thank you. Thank you very much, Savrala. Yeah. The agenda was circulated by the Secretariat, and I'm sure you all received, the minutes was on there. So this basically is the second part of our AGM. Before we start, let me just also I hope that this time around, members found value in the speaker. I certainly did. I found quite some value. I have, really listened to Nikki previously, but I think this time around, really, I think this was good for our industry, particularly for Savrala at this time. So I'd like to just officially just open this meeting now, this the formal AGM. We have received a couple of apologies. I know that Bruce, the CEO of First Car Rental, had sent me an email. There's quite a few individuals that have indicated that they will be coming through, but they'll leave, sometime during the meeting. Other than that, Secretariat, I'm not too sure if there's any, but if you could perhaps, just on the chat group, if you could perhaps just type in any sort of apologies. I know some have been sent directly to Warren, who's our Secretariat. So those are up so that those apologies could be recognized. And then the minutes were also circulated. I'd like to just confirm we're not going to go through the pages. We'll just assume and basically take them as read. I have reflected on them. There aren't really nothing much. A lot of what we will touch on. Thank you very much. I see there's an apology from Bonisile Kubalo from Fleet Africa. Noted. Thanks, Yoko. And then I basically, I think it's a reflection of what was discussed almost a year ago. I have to indicate that this is almost the first in a number of years where we've had, the AGM after Moti. We always had the AGM first, and then afterwards, then we'll have Moti. But I think circumstances, led us to this, and it's good that we are just going to focus on this instead of having combined sort of, meetings. So going back to the minutes, I think the minutes were a reflection, and I'd like to just have these minutes adopted. If there's any matters arising perhaps from those minutes that were circulated by the Secretariat, if members could also just raise their hands and indicate. And then we can adopt them accordingly. Thank you very much. Thank you. Thank you, Jonathan. Thanks. So we'll take those minutes as a true reflection of what transpired at the time, and adopt them accordingly. We'll get them signed by the president. The next item on the agenda is the chairperson's reports. We'll have reports from the rental chair, Granville Salmon, and then shortly thereafter, we'll get a report from the leasing section. It's led by Brian Roos. And then after that, we'll look at the matters arising from those reports and then adopt them accordingly. If we could move on, I think our first one, sorry, Grant, it's not going to be yourself. Oh, yeah, it is. Yes, certainly. Thanks. There you are. Grant, over to you.
Thank you, Sandile. Welcome to everybody to the car rental section of the AGM for 2021. And it's just amazing how the pendulum swings, huge movements. To think a year ago we were mainly worried about COVID, now we're worried about load shedding. A year ago we were worried about how to defleet our oversupply of vehicles, now we're worried about undersupply of vehicles and the impending chip crisis. So, I mean, massive swings. Our overall fleet is still sitting at around only 42,000 rental vehicles, and it's likely shortages will be the order of the day for the rest of the busy season this year. Just to give a few insights into the state of the car rental industry and the tourism industry in South Africa. Before COVID, the two busiest routes in air travel in Africa were Johannesburg, Cape Town, and Johannesburg, Durban. Cape Town had 13,000 travelers a day, and Durban had 8,000 travelers a day. And Cape Town had just entered the world's top 10 busiest routes in the world. So the stats right now compared to 2 years ago. In September, OR Tambo had 1.8 million arrivals and departures that were at OR Tambo. In last year, there were 294,000. So from 1.8 million down to 294,000. This year in September, there were 772,000 arrivals and departures at OR Tambo. So air traffic is still down 59%, and that's at our busiest locations. So compared to pre-COVID, 59% decrease in air travel. And we are very much dependent on that air travel to boost the car rental businesses. So with South Africa coming off the red list, we now have excess demand, and the only lever to balance the demand and supply now for us is price, because we cannot increase the number of vehicles rapidly enough at the moment. Yeah, so it's definitely one of the most interesting years I've ever had in business. And almost every day dealing with different constraints, new externalities. It's really been, you could look at it as frightening, but it is actually quite interesting to be in business at the moment. When one compares the pre-COVID stats for Savrala to the current stats, you get a true picture of the changes in the industry. And we should stress that as car rental, we've been relatively fortunate. I think vehicle manufacturers, hotels, accommodation, restaurants have been far more severely impacted. So the top line, the reductions for car rentals since before COVID, the fleet size is down by approximately 40%, from 70,000 to 42,000 vehicles at the moment. The number of kilometers driven is still down more than 50% from before COVID. The revenue is still down 46% from before COVID. So we used to do around about 600 million rand turnover per month. And last month we did 324 million rand turnover. So it's quite substantial. Rental days are 49% down, but the one thing that makes car rental companies profitable is utilization and obviously rate per day. And the utilization is the highest it's been almost ever as far as the stats go. Obviously, that's driven by over too much demand and an undersupply of vehicles, which is from the chip shortage. So that's basically the state of the car rental industry. In terms of Savrala, the crime is definitely on the increase, and our safety initiative is definitely one of the most valuable forums at Savrala. Currently, we've been investigating a syndicate that stole more than 20 vehicles from the car rental industry in South Africa, and at least one of the sort of syndicate members has been arrested. We've also had amazing success working with the SAPS on our SAPS car rental WhatsApp group, helping the SAPS locate and arrest people that are using our vehicles to commit crimes. Generally, bank robberies, ATM robberies, hijackings, those type of things. If the police see that one of our vehicles was used, they pop it on the forum, and immediately we can give them the information they need to address those issues. So, through this forum, we've been able to address a greater number of risks through technology, and the forum aims to keep all members up to date on the latest trends and risk management. With respect to ARTO and NATIS, although it's kind of not a huge victory in that they haven't changed the ARTO Act, but all the sections that we had issues with in ARTO have formally been delayed. So I think that was a major contribution by Savrala and Sandile through his seat in BUSA to make sure that we lobby governments, and essentially we got half of what we wanted. It hasn't been implemented, but the law has not yet been changed. The major issues here, just so that people are aware, is the difference pertaining to fleets and individuals, and the impact of points on the points on vehicles, and demerit points applied to vehicles. So if a renter gets a demerit point, that gets applied to the vehicle. In terms of road safety, as you can see from the number of kilometers, there's a lot less road accidents, and safety has not been top of mind. It's one thing that is apparent, is that the alcohol causes accidents. And the closure of liquor stores has really been good in terms of safety. And safe roads means lower accidents rates, lives saved. And the three major focus areas include more road safety programs, more budget for road safety programs, better roads, and better policing laws, and compulsory third-party insurance. Those are the items we push as Savrala, but obviously in the last year it's mainly been focused on ARTO. The TransUnion Closed User Group. So this is a forum where we share information about errant debtors. The group is met during the year, and certainly this syndicate that's been hitting all the car rental companies has been using fake credit applications. And this has been one thing which has really been quite good, the sharing of information between the car rental companies. So in conclusion, 2021 has been a year where again we've needed to use our unified voice to speak to governments, and we've succeeded with ARTA. And again, we've seen that a powerful unified voice is worthwhile. So Savrala is worthwhile. Although there have been massive downs, they may have been lessened by the unity shown amongst the car rental businesses. I wish everybody the best for the upcoming year, and I thank Sandile and the rest of the NEC for their hard work in the year past, and congratulate the mighty winners. Thank you for the opportunity to serve Savrala. I appreciate it.
Thank you very much, Grant. Thanks for that report. I think you've beautifully captured just in brief some of the key highlights, and I just need to also indicate I don't want to put words into your mouth, and when I say you, I mean in this case both yourself, Brian, and the president, who are still going to speak. But I'd like to just assure the members that there will still be a comprehensive feedback on the latest on ARTO. We are in the process of finalizing, basically we've made our inputs yesterday. We've submitted our input in terms of just finalizing the NEDLEC report on ARTO. As I said, I think in the last members meeting, something very unconventional has happened, where a report, before NEDLEC could finalize its work, the ARTO was basically implemented on the 1st of June, and it's never happened before. But it just shows you why the insistence on the department to introduce that piece of legislation, but at the same time it shows you the amount of problems that were attached to this, and the vehement opposition by the parties that sat around that ARTO task team. But certainly I can assure that a report will soon be circulated. We'll prepare a report just for Savrala members. But at this stage, just in terms of the subcommittees, rental, Granville, you have my assurance. Basically, last year and COVID has really seen us take a bit of a back relaxation in terms of just getting some of these, active. However, we've gained a lot of members over the past, which is some good, and would like to encourage members to ensure that as we institute these subcommittees in the new year, that they make their staff members available, the relevant staff members available. So at this stage, thank you very much. I'd like to just call upon Brian to take us through the leasing report. Thanks.
Thanks, Andilis. Thanks, Green. Members of the NEC and all the members that have joined us today. I apologize for not sharing video here. Hope you can hear me. I've had some connectivity issues, so I'm just going to share my, Sandile, if you can maybe share my presentation.
Sure. All right, we'll move on to your, let me just, Steph, if you could please just move to that next slide.
Thank you. Yeah, I'd like to just start. I think we've gone too far there. But in any case, I just before I get to that slide, just maybe just talk to the fact that to welcome, we've got 3 new members this year that have joined us, and I'd just like to welcome them officially. MDZ Fleet Solutions, ADN Fleet Rent, Simunye Fleet Management. Just want to welcome all of them as new Savrala members. I would also then just like to say thank you to Sandili for spearheading the golf day that we've recently had, and we were able to raise 105,000 Rand towards the Kids Haven and Benoni. And just thank you for all the members that contributed to the wonderful golf day, and we hope to hold one in the coming year. And we hopefully would be able to attract more people for the golf day. So we'll definitely look forward to that. I would then also just briefly want to talk about we've got a advanced diploma that members can do through Stadio. But if that's too big as a training, you're also able to do it just as a single course, and it was put together by basically the industry experts, and it's a very practical course for people getting into leasing, not only for leasing companies, but in the past we've had some inquiries from the manufacturers as well, in terms of people interested in terms of how the leasing industry works, and it really talks about the whole life cycle of vehicles. I would really encourage members to consider that as a training aid for the staff. We didn't have a lot of participation in that, and we do risk the fact that Stadio might, they've indicated that they might stop presenting the course for us, which will be a problem if we don't get enough members that will do the course in the coming years. I really want to use the opportunity to urge members to definitely get their staff to do that, because it's a well-worth course. Getting to the leasing trends, high level, I can just maybe talk, just touching on stats like Grenville did. We saw before COVID versus where we now, a reduction of about 17,000 contracts on our books in terms of the numbers that we collate. We've also seen that the new vehicle purchases that have basically halved before COVID versus where we are now. So a massive impact as far as the leasing industry is concerned. If we talk to, you can go to the next slide, thank you. If we talk to just the leasing trends that we've seen in the year, I can talk to the fact that we've definitely seen the fact that there's been less brand loyalty because of the fact that people have been forced to look at other vehicles or other makes that we didn't see before. And I think also we've seen our customers becoming a lot more cost conscious. We're seeing a lot of buying down trends in terms of the vehicle selection criteria. We've also seen, obviously, with the lockdown, less mileage being driven by the vehicles. We've also seen the emergence of a couple of new vehicle brands. I'm thinking about Arval making a big impact. Suzuki has been shooting the lights out over the last 12 months. And I'm always reminded about an old colleague of mine that he used to work for the #1 vehicle manufacturer in the 1970s. And in those days, they weren't NAAMSA, and they used to telex each other the total sales for the months, and that's how everyone got a sense of what the market was doing. And he was telling me that in the early 1970s, when he collated the figures for the #1 OEM at the time, they saw Toyota moving into the #10 spot, and the question was asked, should we worry about them? And the board members unanimously agreed not to worry about them because, as they put it at the time, they can't see a farmer buying a bakkie from the Japanese. And look what has happened. And I think that what makes it so exciting in terms of these new entrants in the market. And we hope to see what they'll do in the future. We've obviously seen everyone is aware of the stock availability issues that we've been seeing, not only in terms of vehicles, but we're now starting to see it in terms of service basket parts, crash parts, and the like as well. So you find that the downtime in terms of vehicles fixed is getting longer, and also practical problems in terms of finding suitable vehicles for customers are becoming more urgent. As far as I had a lot of inquiries this year as far as electrification of vehicles, and from a Savrala point of view, what we foresee now. Ultimately, I think the view has always been that we treat it very much like any other vehicle, and we put it on the books like any other vehicle. But I think just things that you can ponder about in terms of electrifying of vehicles is the fact that the press keep on reminding the world that we're seeing such huge uptake in terms of electric vehicles in the Scandinavian countries, but what they don't report on is the fact that that's built on the base of massive government subsidies, something that in the tune of over 100,000 in the vehicle. So we don't see that, we don't foresee the government actually having the money to do it in South Africa. So we just keep that in mind. I think the other thing is the fallacy that these vehicles don't have maintenance costs incurred, which is not true. They still have standard rubber tires. They still have conventional brakes. And those are the two biggest maintenance items that you see on your top 10 maintenance item list. As far as resale is concerned, these, remember, you lose about 5% of your battery capacity within the first 3 months of using it. And as the vehicle gets older, your range decreases as the battery loses its efficiency. And ultimately, your resale value is attached to the basically the quality of how strong the battery is at the end. What we're seeing in America with Tesla models is that when the battery does fail, you find that the vehicle basically has scrap value. So I think just things to consider when putting those units on your books. But ultimately, we see the future as electric, and we'll definitely see the introduction. We're already seeing these models in South Africa. So we definitely foresee that is the future, but I suspect that it's going to be a bit slower than the uptake that we're seeing in Europe. We're seeing an increase of people using Uber-type services, but it is not really affecting the leasing industry because we deal with corporates and not with individuals. Moving on to the next slide. The one item that I just, Sandile, can you guys move to the next slide? The one item I just, thank you. That I want to talk to is the fact that, I mean, one of the things that COVID has really brought to the attention is the fact that we really need to reconsider our risk mitigation strategies. And here I've got the ubiquitous bell curve, and its biggest critic being Nassim Taleb. He's the author of a couple of books, including Black Swan, that I could recommend for anyone interested in risk. And the name, obviously, these days we talk about COVID-19 as a black swan event, and the name originated from the fact that until the 1800s, no one had ever seen a black swan. That was until the British stumbled on Australia and they found that there's something like a black swan. And the point that he makes is the fact that you haven't seen something for a very long time doesn't mean it can't happen. And I think that's pretty much what we're seeing here with COVID. And now with we in level 4 load shedding, all these things that you can't imagine happening, it is possible happening. And the point that he makes, and I think a lot of South African companies are guilty of this, is the use of the bell curve, because we tend to average things out. We tend to, and by doing that, you obviously like to extend. We look at the past to predict the future, so we tend to extend the lines in terms of data, and we think that's a good representation in terms of what's going to happen in the future. But the point that he makes is that by averaging things out, you find that you lose those risks, because if you look at these tail ends of the bell curve, the probability of those things supposedly happening is so low that companies don't foresee that ever happening, and they don't plan for that. But I think what is, and I mean, just to use the point of extending the past for the future. I mean, people forget that in 2001, Eskom won the award for the best power producer in the world. And if you extended that line, you would not expect that we now would be at level 4 not lockdown, load shedding. So again, it's risky to extrapolate lines and to average things out. So definitely something that we need to consider. I think there's huge opportunity because I think we're in the transition phase in terms of the economy, in terms of where you're going and what the world economy is going. On the positive sides, I'm seeing the demise of things like just-in-time that for 40 years were purported to be the golden rule. But now people are realizing, gee, to have inventory is actually not such a bad idea because you can sell nothing of nothing and you get nothing. But you can have at least something, even it might be a bit more expensive, but by having stock, you are actually able to transact and do business. So to those members that will adapt to these trying times, they should see success. It's a brave world we live in as we stand. And I think we need to rethink the dogmatic approach just as far as risk management is concerned and a better plan for these contingencies, because the fortune would most definitely favor those that are prepared for these quick and changing environments that we do live in. Moving on to the last slide, our focus areas then for the coming year will then obviously be, I think Grenville and Sandile mentioned Archer. I'm not going to talk about that further, but obviously further engagement with government as far as that is concerned. As I mentioned, from a leasing point of view, we really want to promote and market the training with our members. And then obviously, just so that the members know, we are going to look at a new funding model for Savrala because of the decline in our income, we obviously need to guarantee our survival as an organization into the future. Thank you.
Thank you, Brian. Yeah, I've just posted a message. I'm not gonna comment much on your presentation, but I'm sure there's quite a bit for members to reflect on, and especially just what we will be focusing on next year. Load shedding continues to wreak havoc. Sorry?
Can I suggest you stop your video?
Yes.
I think, yeah.
Can you hear me?
Yes, now it's better. I stopped your video.
I'm just saying load shedding at the moment. ITM, which is basically to the matters arising from the two, reports from, chairperson, the leasing chairperson, and the rental chairperson. Any matters arising, perhaps from there? And then we can adopt these reports accordingly. I take it I'm still audible. Are there any perhaps matters so that we can adopt the two reports from our chairpersons? Do you want to put up that the next slide, which is basically the chairperson's reports?
Just a moment for me, Sandile. I'm just trying to get past the bad internet connection.
All right, I see Jacques. Oh, sorry, Jackie Parkin. Thank you very much, Jackie. You happy with the reports? You know, these are really interesting times. If you could just move just one back. All right. So we will then adopt these two reports and get them signed off accordingly. Thank you very much. Thanks once more to Granville and Brian. Thank you very much, gentlemen. We'll move on to the next item on the agenda. Part of what was circulated by the Secretariat was a proposal, basically a motion, and I'll just go through this for the benefit of everyone and for the record as well. The motion as proposed by the NEC. The following motion has been proposed by the NEC for consideration at the Savrala Annual General Meeting on the 28th, which is basically today, to extend the term of the current NEC to July 2022. The motivation for that was that the current NEC's term expires in October, which is end of this month. Due to the upheaval caused by the COVID-19 pandemic, the NEC is of the view that continuity in leadership is extremely important. In light of this, the NEC recommends that the current NEC term be extended for 1 year to October. I need to just indicate that when the motion was raised in the NEC, we hadn't circulated the nominations. So basically, whether the motion is there or not, we do have, as you will see as we proceed with the meeting, that we do have a couple of nominations. However, the current NEC has also expressed, the need basically to stay on, or they've made themselves available to serve. So at this stage, I think we'll basically just move on to the election, election sort of office bearers. At which point I'll call upon Warren to take us through that process. Right. Warren, I take it you are in the call. We've had a few nominations, as you know. I don't have the information in front of me because this section was basically going to be run by Warren, but I know for a fact that we received a nomination from Blue Car Rental for the position of the vice, rental chair, the vice chair for the rental section. We also received the same from Evis, and they normally would make contact with those that would, be nominated to confirm.
Hi, Sandile, sorry, can you hear me now?
Now we can hear you. Over to you.
Sorry about that.
Thanks.
Also, just having some load shedding issues here, but we've managed to sort that out. So, morning, everybody, and apologies for not seeing my smiley face. Also, as I say, just a bit concerned about the connectivity issues. If I can just touch on, obviously, the motion that was referred to by Sandile. Obviously, the initial motion was raised by Sandile in his capacity as the general manager to the NEC for the reasons he's already stated. In terms of the NEC, the motion was supported. Hence it being brought to the AGM for the members to ratify or make a decision on. Now, with regards to the nomination process, this being a resolution, obviously what would need to happen is there would need to be a vote, and it's going to be decided on a simple majority. So on the basis that, you know, with the constraints of not having a physical meeting and not being able to see hands raised, etc., I think it would probably be easiest in this matter to possibly, for the people that have an issue with the motion being carried, if they could maybe just raise a hand, so that we can see if there are any, and by number how many. To the extent that there aren't, then obviously the motion gets carried, and the NEC will obviously then be reinstated for another term. So I think, without further ado, just to be able to move the meeting forward, based on the proposal of the motion, is there anybody that has a specific issue with the motion not being taken up?
If I may come in, Warren, that I have requested Big Ambitions to monitor the hands for us. I know Perfect. It gets a bit difficult, but also we've had formal, you know, written support for the motion from Bruce, who's unfortunately could not make it, but we have, you know, represented here by Adele, the first group, first car rental. He has in written form.
So I'm saying basically, you know, again, with the challenges of having a video conference, you know, it kind of refers into having proxy or whatever. So I think, based on the members present, I think the vote will be taken by them. And obviously, as I say, I can't see the number of members that are attending the AGM, but obviously, relative to how many people are attending versus how many people have put their hands up, if we can maybe just get confirmation of that. And obviously, if the no show of hands is higher than the show of hands, then obviously the motion gets carried. So if maybe Big Ambitions can possibly just give us the answer to that question. Okay, so as can be seen in the chat, there were 44 members present. There appeared to be no objections. So on that basis, I take it that everyone is comfortable with the NEC taking on another term. So congratulations to those parties. That would be Corné Venter, Derek de Vries, Grenville Salmon, Brian Roos, and Linda Kamalo. Obviously, there is one vacant position, which you would have seen with the electronic nominations that were circulated, and that was for the position of the rental vice chair. To date, we have received 2 nominations, those being George Corbett from Blue Car Rental and Rian Weideman from Avis Budget. Both of those nominations were accepted by the individuals. So in terms of let's just say in terms of a vote again, unless either of those parties want to withdraw their nomination, can I ask that we just move forward with the voting process? That being that effectively, I think what we'll do is let's take the first vote for George, and then once we have confirmation of a number, we will then go and have the vote for Rian, assuming that there's not already a majority of the 44 parties that are present in the meeting. So if I can just ask everybody, and I'm assuming, because it's very difficult to get a feeling of what's happening, that everybody's happy with the process. If we can just, by a show of hands, have a vote for George as the potential rental vice chair. Okay, if big ideas.
I think people are still raising their hands, and the numbers are.
Warren, I made you panelist so you can actually monitor yourself now, dear raised hand as well.
Okay, so I still can't basically see what's happening though. So
Okay, so we've got 5 raised hand for the moment only.
okay, we'll give it a minute or two. Okay, if we can maybe then move on to a vote in respect of Rian Weideman as being the rental vice chair for the year ahead. If we can have a show of hands in that regard. Can we just get an indication of the current performance? There seem to be a lot of abstentions. Okay, I think there's been sufficient time for all the parties that were present to vote. So on that basis, it's confirmed then that Rian Weideman would be the newly elected rental vice chair. So congratulations to Rian. Not to say that George is out the pot, as the NEC has the opportunity to co-opt further members down the line. But that said, again, congratulations to Rian, and obviously the further term for the balance of the NEC, and handing him back to you, Sandile.
Thank you very much, Warren. Thanks. Yeah, these are difficult conditions. I think the whole process was handled well despite these challenging conditions. Congratulations to Rian. At this stage, we'll move on to the President's report. Just worried that, we're going forward. I think we'll try and move with speed. We don't know what's going to transpire. The whole control, especially, is important so that at least we finish, the program and the agenda. Over to you, Connie. Unmute yourself, please.
Right. Perfect. Thank you, Sandile. Good morning. I'm just confirming that everybody could hear me. If I can just maybe see one show of hands, or Sandile, if you can confirm.
Yes, we can hear you. Thanks, Connie.
Okay, perfect. Great. Thank you for that. So, yeah, firstly, morning to everybody. I think looking at the year gone by, I think, as Africa was built on change, I think so has our industries in the last year. I think we had to contend with a multitude of challenges. And I think I was quite often reminded of the fact that it always seems impossible until we actually have done it. So looking back at the year, I think last year when we had the AGM, we all knew that the future was looking very uncertain. I think we recognized that the industry recovery would be a long and protracted one. But I think little did we know that we are going to have such a volatile year with stop-starts, various lockdown levels and regulation changes that will be thrown at us at the most inappropriate times. I think with all of that being said, I think we looked at the base of where the market has settled last year this time, and we all thought that we've actually bottomed out. Little did we know that there was going to be more surprises ahead of us. So I think looking at our car rental members, our fleet size dropped from about 75,000 vehicles in February 2020. I think that ended up in a low of about 40,000 in September last year. I think we anticipated that that was the bottom, and with obviously a couple of changes resulting in varying levels of lockdowns and second and third wave, I think what we then ended up in a fleet size of about 35,000 vehicles in August 2021. But I think that's not all doom and gloom. I think what is encouraging to see is that we've actually had a substantial upfleet in the month of September. despite some vehicle availability challenges. On the leasing members side, I think they experienced less volatility, and I think it's mainly driven based on the more permanent nature of their contractual relationship with their customers, but they were not left unscathed. I think some of the early signs of recovery that's evident is that we are seeing a definite demand for lending to support business growth. I think we're seeing some transactional activity and more turnover coming through. Improvements in impairments is also quite a positive sign for our leasing colleagues. And I think what that tells us that there's definitely some signs of recovery from the devastating effects of the pandemic. I think looking at Savrala, just briefly touching on one or two of the items, I think we had 3 priorities set out for us at the beginning of the year. One of them being Auto, which I think remains top of mind. The other one was the POPI Act that came into effect on the 1st of July. And then I think lastly, more car rental relevant was the AXA airport tender. I think maybe just firstly, briefly touching on POPI and our efforts in that regard. I think it would appear from our member feedback that our efforts in terms of the Protection of Personal Information Act was well received. And I think it aided our industry with compliance. I think where we stand as Savrala, we obviously remain at your disposal should you require any further assistance. But I think it seems like it's actually settled and most of our members have actually been able to comply with relatively ease. On the AXA tender front, not much progress has been made. I think AXA has been contending with its own challenges. I think as some of our car rental members have expressed interest to participate in the planned tender, the only thing I can report back at this stage is that feedback that we've received from the senior AXA officials as the tender has been drafted, and I think it's currently undergoing scrutiny by the relevant governance and compliance structures. I think what we will do through Savrala is we'll keep you updated as we receive progress. Unfortunately, we're in the hands of AXA, and we will keep you updated. I think biggest challenge for the year was definitely Auto. I think lots of energy and effort went into that, and it remains a mammoth task. I think we're currently facing the demerit system going live on the 1st of July. And I think Savrala has actively engaged the department through NEDLAC. And I think it gave us an opportunity to put forward a couple of our industry unique concerns, and most of those have been resolved. As it stands currently, it's still a work in progress. There's 3 key main items that remains in discussion. One is the nomination process, and I think we're in the process of getting some refinement and some clear definitions from the department on what actually defines a valid nomination. I think the second one, Grenville referred to in his report just on the proposed demerits onto vehicles. And I think as an industry, we are resisting that for practical reasons because we cannot render our assets inoperable. I think the third and last one is the fact that given the volume of transactions that goes through our industry, we need a seamless integration ability into the department's online systems. I think so, just looking forward, looking ahead in terms of priorities for the next year, I think, as I said, Auto will remain a key priority. For us, I think we've got a couple of work groups, and maybe if I can just briefly talk about what we are currently doing on an Auto perspective. We currently have bilateral engagement with the department, and I think we are trying to find some resolution to our 3 main key concerns. I think we've also got a current business analyst working with the department to try and define the integrations and API mappings, and we will, in the next couple of months, have one of our members pilot with the department to make sure that we've got a direct, seamless integration with them. I think once again, giving our members the ability to transact with the department without having any third-party vendors or being reliant on government systems. I think the second thing we want to focus on is just, and Brian touched on that from an industry training program. I think as part of the upliftment of our industry, I think we are formalizing some training programs for both leasing and rental, being a key priority for us for the next coming year. I think we will also be revisiting our subscription model. I think we just need to reevaluate the relevance and the fairness to all of our respective members. I think lastly, given the member engagement we've had a year back, we are looking to just update the Savrala Constitution to make sure that our objectives from a constitutional perspective is aligned with our value proposition. I think lastly, just having had the Manufacturer of the Year Awards a week ago, I think I just want to once again congratulate all of our winners. I think, and then also thank all of our members for their participation. We actually had quite an overwhelming response this year. In conclusion, once again, I would like to thank my fellow NEC members for their support in the past year. I think most of our efforts were focused on contending legislative challenges. whilst trying to rebuild our own businesses. We had very little opportunity to engage with industry as a collective, and hopefully this year ahead will actually give us a little bit more of that. Once again, thank you for everybody's efforts, and it was my pleasure to serve this last year on Savrala. Thank you, Sandile.
Thanks. Thank you very much, Connie, for that comprehensive feedback. I just need to also perhaps just highlight, without regurgitating what you're saying, just give assurance. I had gone out to the members requesting information relating to the shortage in vehicles. I've been in touch in contact with NAMSA, and they appreciate at least the honesty which we're dealing with the matter, and as it gives them visibility on what has been communicated by OEMs, who certainly some are members of Savrala. And at this stage, they are basically looking at how, they're assessing the report that I've given them based on the information we received on the questions that I raised with our members. And they're reviewing and assessing if there's a need to issue a new statement. So I'll leave it at that, because there's ongoing discussions. I think some of our members feel very, very strongly about the statements that were made, when in fact our customers were inconvenienced. So in terms of just Arto, just as the meeting started, I had a call from Advocate Bilikwana, who's one of the delegates from the Department of Transport, the RTIA, to follow up on what you just mentioned, those bilaterals, basically just driving it in now to make sure that we look at that whole integration process. So certainly that will also form part of the report, the feedback that we'll give to members. And we are excited that our business analyst is currently working on just mapping out that whole IT integration. So certainly there's good news that will come our way. And we're targeting that all of this should at least be completed at least 2 months before the implementation of the planned implementation of demerit points, which is 1st July next year. So work is really in full steam. Thank you very much. So if I could just give members an opportunity as well, just matters arising from the President's report. Any matters arising from there? Any questions? And are there any? Let me see. I see there's messages on there. I don't know if they relate to the President's report. So I take it that the members are happy with the President's report. It was crystal clear, and there's no questions. And at this stage, I'd like to have the report adopted. Any member that perhaps would like to raise their hands just to adopt the report. Hi, Brian. Thanks. Thanks. All right. We will have the report adopted and signed off accordingly. I think the next item on the agenda now is the financial matters. And I will again call upon our friend Warren Fletcher to take us through the financial report. If you could move, Steph, to the next slide.
Okay, everybody. Basically, what you're looking at is the financial position of the association at the end of June 2021, with the comparative of the previous year of the same date. The financial affairs of the association are not overly complicated, and as you can see, it basically reflects the position of the country in terms of economics. You'll see that in terms of the budget, income was slightly down for the period, as were the expenses, being that obviously the association was very cognizant of cost management, and obviously with regards to the COVID lockdown, there were significant implications into the industry, which obviously then also impacted on the membership fees. In terms of interest, obviously everyone's aware the interest rates came down. So in terms of the reserves of the association that are with banks generating interest income, that obviously came down significantly. In terms of the MOTI function, obviously over the last couple of years, there have been challenges in holding the MOTI event, considering COVID and the lockdown, but the association obviously had the need to show its appreciation to the OEMs, and on that basis was required to supplement the function costs to an extent. And that obviously led to the end result, which showed a nominal surplus for the year of about 3,000 Rand compared to a nominal deficit last to the period June 2020 of around 27,000. So basically the association managed to keep its head above water in very trying times. If we can just move to the next slide, we can just go through the detail in terms of the operating expenses, which are fairly consistent by nature and by amount. In principle, the general operating expenses are aligned to 4 areas: the accounting and admin fee, the professional services, which include remuneration to the GM and other related parties, statistics to Lightstone, and obviously the facilitation of management to Potion, who does the computer and website updates. The only other interesting one, obviously, if you look at consulting fees, that's obviously come off significantly. The 38,000 that was budgeted was in respect of the magazine that was distributed at the MOTI Awards against the previous year, which basically incorporated the cost of an assistant to the leasing section. So all in all, as I say, not a hell of a lot to it in terms of variation, both in amount and in terms of definition. So that totals the operating expenditure of 1.4 million, which then ties back to the surplus of the nominal 3,000 Rand. I don't know if there are any questions. I'm happy to take any. If anybody has any questions relating to the income statement and or the budgeted figures with regards to the year end June 2021.
There are no questions in the chat, Warren.
Okay, thank you. So if there are no questions, can I just ask someone if they could adopt the financials as presented?
Was adopted by Brian Roos.
Thanks very much. If we can just move to the next slide. Okay, this is basically the balance sheet. As you can see, it's very simplistic in its content. In terms of the trade receivables and the trade payables, that's really just a timing thing in the sense that it really reflects invoicing that's done just pre the financial year end, and obviously those fees are shown as fees in advance, which then show as trade and other payables. So for all intents and purposes, you'll see that the accumulated surplus is in effect set off with the cash and cash equivalents, which is obviously the money held in the bank accounts that generate the interest. So in terms of year on year, you'll see we've managed to pretty much break even in terms of maintaining the same accumulated surplus, but it also shows that the association has got a fair amount of liquidity on its balance sheet. Are there any questions with regards to the balance sheet?
All question in the chats.
Okay, if again I can just ask someone to adopt the balance sheet.
Has been adopted.
Thank you very much. If we can then move on to the proposed budget for the year that we effectively in. Basically, again, have the association and the NEC having consideration for the economic circumstances that prevail at the time, the decision was taken to basically go with a 4% increase, which is basically the CPI index. So as you can see, pretty much the same as 2021 in the sense that 2021's actual was 1.4 million. We're going in with a budgeted figure of expected income, taking into account an expected loss on MOTI of 1.4. If we can just go to the next slide. Okay, again, with regards to the budgeted costs at a 4% incremental increase on the actuals incurred for 2021, you'll see that we contemplate a nominal deficit.
Sorry, Warren.
Yeah.
Steph, can you please mute Connie? I think it's the sound comes from his office here.
Okay. Okay, back on track. Sorry, I'm not sure if everybody heard. So again, in terms of the proposed budgeted costs and expenses for the 2022 year, you'll see it's very similar to what we incurred in actual spend for 2021, which provides a nominal deficit of 6,000 Rand, which, as I say, having due consideration for the implications of COVID, might effectively be wiped out, dependent on whether physical meetings are able to be held going forward, where you can see we've provided 24,000 Rand in the budget. As opposed to that, it's really, again, the four main costs elements being the professional services, the stats, the accounting and admin, and obviously the website and computer maintenance. So again, not overly complicated. And as I say, basically budgeting on a break even. So I don't know if there are any questions or concerns relating the budget or relating to the budget.
Nothing in the chat for the moment, Paul.
Okay, so if I can then assume that it is accepted by the membership, and if we can just call for that to be adopted.
Thank
Anyone?
you. It has been adopted.
Okay, thank you very much for that. If I can then just hand back to Sandile in terms of having the confirmations of the relevant contracted parties. Thanks.
Thank you. Thank you very much, Warren. Look, I think at this stage we'll move on to basically just, you know, as you've indicated, just the confirmation. We have the appointment of auditors, which was, you know, approved by the NEC, and the appointment of the secretary. And these are basically coming from the same company, Alchemy Financial Services. And if I could, perhaps they were effectively approved by the NEC, but I think we've got to bring it to DM, you know, for ratification. That is the first two I'm starting with at this stage. Just the appointment of our auditors, which is Alchemy Audit Services, and then the appointment of the secretary, which is Alchemy Financial Services, represented by Warren. Any hands there to just ratify? And okay, we've got got a couple of hands there, 4 or 5. Thank you very much. So we'll take that as approved by the AGM. I think the last one relates to just ratifying the secretarial and accounting fees as reflected. I think it was in the last but one slide, which reflected an amount of about 200K for the year 2022 for the accounting fees for 2022. If I could again just get members to raise their hands if there's any objections or approvals. Thank you, Brian, and I will need another hand there. Thanks, Bradley. Thank you. All right. Thanks. So we take those as accepted by the AGM. Thank you very much. The next item on the agenda, and I assume that I will still perhaps just hand over slightly if we could, but the AGM has adopted the motion, and the NEC has accordingly been basically reinstated back into their positions, and I think we had the election of just that one position that saw Rian appointed as the secretary. One thing important to note is that according to our constitution, the NEC still has the powers basically to co-opt a member. It's something that gets done in the very first meeting of the new NEC as it starts at work. There is, a very important points that were raised by members that we always want to ensure that at least there's a broad representation from membership. I think that particular clause for co-option does allow the NEC at least and ensures that that representation is effected. So at this stage, the point 13, the election of office bearers, Warren, if you could correct me if I'm wrong, I think basically it's just a moot point at this stage.
Correct. You just have to basically confirm the NEC. So I'm happy if you do that.
Right. So as it stands at the moment, thank you very much, Warren. As it stands at the moment, to confirm the NEC, we have Kone Fente, who's the president of Savrala. His deputy is Derek from Standard Bank. Congratulations to those. And in terms of rental, we have Granville as the chair of car rental section, and then Rian, who's just been appointed the vice chair. And on the leasing side, we've got Brian as chair and Linda as the vice chair. And basically that is the composition of the NEC. As I indicated in the very first meeting, one of the key agenda items is the co-option of additional members to assist their work. I'd like to congratulate the new NEC and thank you very much. All right, I think we move on from there. If you could just move down. The next item basically on the agenda is the confirmation of the NEC, which I've just done. And if I could perhaps just make a couple of announcements. There aren't much really. These were referred to in the speech by the president. I'd like to just move on, Steph. I'd like to just reflect on perhaps the MOTI, the recent MOTI. We had a very, very successful MOTI event last Thursday, and I'd like to congratulate all the winners. And at this stage, I think let me just reiterate what was reflected in many of our statements. And congratulations to Isuzu, who has become who has come up tops as the winner of the annual Industry Manufacturer of the Year Awards 2021. This was announced last week, as you know, in I think what I would refer to as a very, very successful cocktail event last Thursday. The Mochi 2021 winners included Isuzu, as I indicated, as the winner in both the rental and leasing categories for the second consecutive year. Volkswagen came in second place in both categories, and Toyota came third also in both categories. The value award goes to Toyota, fourth year running again. And the value award, as you know, is presented to the automotive member, which has scored the most combined points in the financial sector. And for the fourth year running, Toyota is the winner. And the last, not certainly the least, the Mini took the Tutuga Award third year in a row. And the Tutuga Award is recognizes the best scoring automotive member who supplies lower and niche vehicle volumes to the car rental industry. And Mini took the honor in this category for the third consecutive year. We also saw a new entrant here, and that Haval also had an award in this case. And I'd like to, on behalf of the NEC, just to congratulate all the winners. And I think for the first time where we gathered, I think it was quite a success, a successful event. And we've continued to receive very positive feedback. And then the second one is just to also just thank the members for the contribution they made with regard in the last golf day that was held about in September, just towards the end of September. I think, again, I think I have circulated the note that was received from the charity that we chose. And it was quite humbling. We've managed, after 4 years of a break, to raise 105,000, which has been handed to Kids Haven. And I'd like to thank again all the sponsors, that contributed and sponsored various items, including financially. I think we are set, as indicated, to look at review, our key focus areas, certainly in as the year starts. But I will be in contact with the car rental and leasing, members, CEOs in particular, to, as we start planning for our first meeting in the new year, which is the CEOs meeting, where we really get, the marching orders as an NEC, and members will be contacted accordingly. But also, we're looking at, resuscitating a lot of our subcommittees, some of which really, whilst they were not meeting physically, but they've made strides, as was reflected in the various reports from the chairs of rental and leasing. But we are looking as things are opening up, and the relaxation of these lockdown conditions as well. I think it affords us the opportunity to can at least now also start meeting in person. But I'd like to also extend my thanks to all of those that were available, and I once more encourage particularly the new members to ensure that at least they make themselves available to participate in these subcommittees. On that note, I think I'd like to just thank
Sandile, I'm afraid we lost you. I don't know if you can hear us. I'm afraid we lost Sandile. Maybe Brian or Grenville or Warren want to carry on the meeting.
Yeah, I think, Brian, yeah, while we're waiting for Sandile to reconnect, I think basically we were at the end. I'm not aware of anything further. Warren, is there anything formally that we still need to conclude?
No, as far as I know, we were almost made it to the last sentence, I think. So I think
Yeah.
we're good to go.
Yeah, I think, yeah, at the best, yeah, I think he lost connection, yeah, right at the end. So to all the members, thank you for participating today. And yeah, we'll conclude with that. Thank you to everyone.
Just hold on. Corne wants also to say something. I quickly will unmute him.
Yeah, sorry, just due to the fact that Sandile dropped off, I just wanted to say thank you everybody for attending. I mean, we appreciate your time in the essence of keeping with the actual planned timeframes. We will conclude. If there's any other questions, please feel free to engage either myself, Brian, Grenville, or Sandile. I mean, yeah, thank you very much for your time and attendance.